Hi, everyone. Thanks for tuning in to episode 20 of Takeaways. My name is Patrick Searcy. I'm Director of Marketing for ALN Apartment Data, and I'm joined by somebody who looks kind of like the Senior Market Analyst, Jordan Brooks. Jordan, is that you?
It is me. I'm trying to stay warm over here, and the beard will be back in episode 21.
All right. Well,
so look forward to that.
I do look forward to that. Yeah, you're looking good. You're looking good. This month, this has certainly been one of our more engaged topics in our series and with the newsletter articles that go along with it. And we're talking about that article from March. It's called Clouds Gather on the Multifamily Horizon. So, when I read that title, there's kind of automatically a negative tone to it when I saw the title. But that's even in the face of things like a 5 to 7% projected rent growth nationally for this year. But throughout the article, it's pretty clear you're not saying that it's a storm to be expected. It's more of a chance of rain. Would that be fair to say?
I think so. I mean, the point we kind of made in the newsletter was, if you just kind of look out there in various, multifamily outlets and sources who are putting out their forecasts, a lot of them for annual rent growth were kind of falling in the 5 to 7% range. And we wanted to identify and kind of talk about some potential issues, some potential risk factors that are, a little bit of a change in dynamic from what the market conditions were last year, and not necessarily saying, that 2022 is going to be some terrible year for multifamily, but just kind of, identifying some issues that are worth paying attention to, rather than just assuming that, 2022 is in some way going to be largely like 2021.
Well, the first potential rain cloud here that you talked about is the decline in demand, and you cited a figure of net absorption being down 75% from January 21 versus 22. So talk to us a little bit more about that.
Well, the apartment demand shortfall in January of this year was pretty dramatic compared to January of last year, and it was also pretty significantly lower even than net absorption from January of 2020. And what we saw in February was a little bit of a bounce back, which was good to see. But even so, net absorption in February of this year was about 30% below February of last year. So that's an improvement from 75% down, right? But obviously, still, when we're talking about January and February combined, the demand picture to start the year off is certainly not what it was to start off the last few years. And the fourth quarter and the first quarter are generally softer portions of the calendar for our industry. But even so, we're comparing the first 2 months of this year to sort of the same portion of previous years, and so that's sort of the first kind of cloud that we identified in the newsletter is that, okay, well, the demand picture that was driving the rent growth in 2021 has, at least for the first 2 months of this year, changed.
Well, the next cloud is actually kind of twofold. It's the affordability crunch. And the first part of that affordability crunch was the rent growth that we've seen over the last handful of years, which is pretty impressively high. There were some interesting numbers in there, but share your take on affordability for rent growth.
So, as you said, we broke affordability kind of into two sections in the newsletter. The first one being just recent rent growth. And we saw, at the national level, about 15% average effective rent growth in 2021. And what we did was basically we took, instead of the average effective rent, we took the median, which was actually a little bit higher in terms of annual change. We took the median effective rent and the median household income and just looked at the change in that ratio in recent years. And there's quite a bit of noise in those numbers. I mean, obviously there's households of various sizes that are all included in that median household income number. Just as with median rent, we have, efficiencies all the way through 4 bedrooms or more in family. So, but still, just kind of as a directional measure, looking at the change in that ratio over time, it can give us some information. And so what we found was that, just from 2019 to 2021, median effective rent went from 20% of median household income to 23%. And that might not sound like a huge change, 20 to 23%, but if you think about that change on a percentage basis, right, that's more than 10% in just a 2-year period. And so that kind of changes the picture a little bit in terms of affordability from a rent perspective. And then the other thing we looked at was basically just looking at how much the median income has gained in recent years versus the median rent gain. And so we found that from 2019 to 2021 nationally, household median income rose by 4%, while rent rose by 19%. And so what that really equates to is about $233, I think it was, more in median household income per month, and about $227 per month more in the median effective rent. And so it seems like, okay, well, the income growth has basically taken care of the rent growth, but you have to remember that the income number is pre-tax. And so when you factor in income tax, that difference actually goes negative in terms of rent growth being more than income growth. And then you also have to keep in mind that there were multiple stimulus payments that were going on in 2020 and 2021. The child tax credit was made larger, and it was made basically direct deposit rather than an actual tax credit at the end of the year. And so you factor in the rent gain as well as less money coming into people's pockets. And what you actually find is that the difference between income gain and rent gain is skewed toward the rent number.
Well, that naturally goes into the second part of that, which is the dirty word that you hear a lot these days, and that word is inflation. So talk with us about that too, and how that figures into the affordability crunch.
Yeah, I mean, inflation obviously is one of the big topics of the day right now. The February numbers were something like 7.9% year-over-year gain in the consumer price index. And a big portion of that obviously is energy related. And we went into some detail in the newsletter, kind of identifying the top 10 categories of products in terms of year-over-year inflation. But even so, there are items on that list, whether it's used cars, new cars, airline fares, groceries, that are really impacting people on a daily basis. Not to mention paying at the gas pump. And so we can't just factor in when we're talking about affordability, incomes, and rent growth. We need to also consider what other expenses people have outside of rent. And so, and I think this is something too that it's important to keep in mind, because, there's no near-term solution in sight really for this. And if anything, the problem might continue to be exacerbated. I mean, I saw an analysis the other day talking about wheat prices, and something like a quarter of global wheat comes from Russia and Ukraine, and they're now no longer really exporting that wheat. And so this is something that, if anything, could continue to compound as we move through 2022.
It certainly feels that way, especially, every day it seems like there's a new take on it, and a new way of looking at the inflation, what's going to happen. We'll switch gears here a little bit. We have a great friend as a company. We got a great friend, Nick Barber. He's the owner and CEO of YouMoveFree.com. Real sharp guy, very perceptive. And he had some really great insight into this next potential rain cloud that he brought to your attention. So tell us a little bit about your discussion with Nick Barber and some of the further research into this potential rain cloud dealing with evictions.
Sure. So yeah, I mean, Nick kind of brought to the forefront of my attention. I mean, we're all sort of aware of the eviction issue related to the pandemic, but he kind of brought to the forefront of my attention just what the impact of some of these eviction policies had been, and passed along a pretty good data source, Eviction Lab. It's kind of notoriously difficult to get good data on evictions, just because there's not really a great centralized source for that type of data. And so, really, I think that the bottom line on the eviction situation is that a lot of the policies that were put in place, including the federal sort of CDC eviction order that was in place, that the idea was that these policies would keep evictions sort of near a historical norm level during the pandemic, rather than flooding the system with a ton of evictions, as people were, for certain periods being told you can't go to work. But the actual impact of those policies ended up being that we had a major shortfall in eviction filings that really persisted not only in 2020, but through 2021. And so as the federal order expired, for those areas that didn't add local or state orders on top of that, in the subsequent time period, we saw a delay of a few months, and then evictions really started creeping up and up and up, to the point now where in recent months we've seen filings in excess of sort of the historical average that was established from 2017 to 2019. For areas that added their own local or state orders on top of the federal orders, they're a little bit further behind in that timeline. And so that's why we made the point in the newsletter that this is going to be an issue that likely plays itself out across 2022, just because, again, there are some markets that are at different periods in this sort of general eviction timeline. And so, in some markets, we're talking about, tens of thousands of evictions that in normal times we would have expected to see, just based on average numbers that we did not see. And so obviously, there's an impact there that could be felt in terms of average occupancies. This will vary based on market, based on property type or price class, that this is not going to be a uniform effect. But of course, there will be an impact. And we also identified in the newsletter kind of some mitigating factors. A couple of those would be that, for one, some operators have been trying to get ahead of this to the extent possible, again, based on sort of local regulation, basically by doing non-renewal of expiring leases, and just kind of handling the issue that way. Also, we have to keep in mind that we're coming at this from a point where, national average occupancy is almost 95% and annual rent growth was in double digits. And so operators are at least kind of facing this issue from a position of relative strength in terms of cash flow and what's been going on over the last year and a half. And then lastly, I think it's important to remember that, these filings are for delinquent residents. And so we don't know the extent to which maybe they were behind on payments, or what percentage of their total lease they ended up actually paying. But these people, as they kind of fall out of the occupancy numbers, are going to be replaced, at least to some extent, with full paying residents. And so, even if, and there is something of a concern that maybe the demand is not going to be there to fully replace the residents, it's important to keep in mind that, if you're losing occupancy on someone who paid 30% of their lease, even if you're bringing in a new resident at a rent growth number that you don't see as ideal, you're still going to be able to replace that, say 40% or 30% of rent paid. So I do think it's going to be something that plays itself out this year. Again, I do think some markets are going to suffer more than other markets, and it's just, as with these other issues that we identified in the newsletter, it's just something that is worth paying attention to and watching as the year unfolds.
Well, for our viewers here, if you have any additional comments on this particular topic, because it sounds like there could be a lot of schools of thoughts, on what will and what may and what can and what cannot happen. Tell us down in the comments. Love to hear your opinions on this.
And each of these items could have been their own article,
So they really could. Yeah, there's an awful lot to unpack. So yeah, if you have any additional comments on any of this, please feel free to let us know down in the comment section. But after all of this, though, Jordan, what do you think is the biggest takeaway for our readers and viewers from this article?
I would say it's probably that none of this is to say that the fundamentals for multifamily aren't strong and haven't remained strong. There's a lot to be optimistic about in terms of the near term for multifamily, for sure. I think it's just a takeaway would be, it's important not to just assume that what we saw last year is going to just naturally carry over into this year. And I think it's important to, these specific issues that we identified in the newsletter, these are things that can be monitored now moving forward. So, as we get into the end of March here, and at ALN, we're going to start doing our quarterly review type of content. Looking at what the demand numbers end up being for March, watching what happens with inflation in the coming months, watching what happens in your specific market or across your portfolio, and the eviction situation. These are sort of metrics or data points that can be monitored moving forward, and that should be.
Well, it's starting to look a lot like pre-pandemic event season for many of us. So if you want to see ALN out in the wild, we'll actually be exhibiting at 8 different trade shows in April. And I'm going to put the dates and places, our booth numbers and all that in the description down below. But a special shout out in April for TAA 1 Conference and Expo, where Jordan, you have a session on Wednesday, the 27th, called Everything is Bigger in Texas, Especially Apartment Demand. And don't forget to register and see ALN in booth 401 for that one. What else do you have coming up next, Jordan?
Yeah, so I think in the near term, I've got a presentation for the Apartment Association of Greater Los Angeles on April 7th. That one is virtual. And so viewers of this can be on the lookout on our social media for registration information for that, if that's an area that's relevant to them. And then also April 20th, I'll be in Boise for the Idaho Apartment Association sort of annual conference there. And that, I think those are my only 2 until TAA, and then we've got some more coming in May, of course.
Well, keep your eyes out for more information on our social media and within our blog. You can follow us on Twitter at ALN APT Data, and you can also find us on Facebook and on LinkedIn. Just search ALN Apartment Data. Subscribe to our YouTube channel and hit the bell for the notification of all of our new content that we put out on YouTube. Jordan, this was an awful lot to unpack today. This is a great article. I really appreciate your time and research into all of this. And I can't wait to see you and a partial beard next month.
Thanks, Patrick. I'll see you next month.